As an individual, you've probably set up a budget for your income and expenses. Businesses also have budgets, and they are very important. They are so critical to operating a company that additional steps are taken to analyze the differences between the planned budget and what was actually spent. These differences are called cost variances. Cost variances can come in two general categories, material and labor. Material cost variances can be further broken down into price and quantity variances. Labor variances consist of rate and hour, sometimes called efficiency, variances. When purchasing materials used to produce products, a difference between the planned and actual cost may be a result of different prices paid, different quantities purchased, or a combination of both. In order to figure out where the differences occurred, we need to know four things: actual quantity, actual price, standard price, and standard quantity. For the purposes of this lesson, we will assume that you are a manager reviewing the differences between planned and actual budgets and are given the following budget information: actual quantity, AQ, $5,500. Actual price, AP, $23. Standard price, SP, $25. Standard quantity, SQ, 5,000. Once we know these four pieces of information, we can use a formula to determine price and quantity variances. There are 3 steps to computing the total variance that will provide us with enough information to analyze the data. Step 1. The price variance is determined by using the formula AQ times AP minus AQ times SP. 5,500 times 23 minus 5,500 times 25, 126,500 minus 137,500 equals negative $11,000. Step 2. The quantity variance is determined by the following formula: AQ times SP minus SQ times SP. 5,500 times 25 minus 5,000 times 25, 137,500 minus 125,000 equals $12,500. Step 3. Both of these are added together to establish the total material variance. Negative $11,000 plus $12,500 is equal to $1,500. As we can see from looking at the planned and actual costs, it initially appears that the company overspent by $1,500, but without any details, we cannot determine what the reason was or get the full picture as to whether this was a truly bad thing. As we look further into the different variances, we notice that the price variance was $11,000 less than what was expected, due to a $2 price discount from the standard price. When we look at the quantity variance, we notice that the company was able to purchase 500 more of the item. The reasons for this may have been to meet additional production demand or to take advantage of a price break for a particular quantity. The additional quantity caused a $12,500 increase over what it would have been at the standard price. The information provided does not tell the entire story, but gives the manager enough information as to where she would need to go and what questions to ask in order to understand all of the reasons for any difference between planned and actual budgets. Labor variances are very similar to the material ones, except that we are not looking at price and quantity differences, but instead are analyzing differences in the labor rates paid and efficiency used or not used. The 4 pieces of information needed are actual hours, actual rate, and standard hours. You are being provided with information that will help you assess the direct labor variance. Actual hours AH, 3,400. Actual rate, AR, $13, standard rate, SR, $12, standard hours, SH, 3,800. Step 1. The rate variance is determined by using the formula AH times AR minus AH times SR. 3,400 times 13 minus 3,400 times 12. 44,200 minus 40,800 equals $3,400. Step 2. The quantity variance is determined by the following formula: AH times SR minus SH times SR. 3,400 times 12 minus 3,800 times 12. 40,800 minus 45,600, negative $4,800. Step 3. Both of these are added together to establish the total direct labor variance. 3,400 plus negative 4,800 equals negative $1,400. Upon review of the complete labor cost analysis, we see that the company spent $1 more per hour of work, but was able to save a total of 400 hours, which resulted in an overall savings of $1,400. This may have been the result of a pay raise for workers or some other incentive program to get them to work more efficiently. As such, the company ends up saving more money in the long run. Cost variance analysis is very beneficial when starting an employee incentive program, especially those that deal with a change in pay. Cost variances can be in the form of material or labor. Material cost variances are broken down into price and quantity variances, while labor cost variances focus on rates and hours efficiency. The material cost variances is found by computing actual quantity, actual price, and standard quantity. The labor cost variance is computed using actual hours, actual rate, and standard hours. The analysis of only the numbers may not be enough to provide the entire story of what happened, but it will give the manager the information necessary to know where to look to find out why prices, quantities, rates, or hours were different from the budgeted amounts.